All right, good morning, everybody, and welcome to another self-directed Saturday. My name is Freeman White. I'm an IRA specialist with Quest Trust Company, and today we've got an exciting speaker for you that's going to speak on um, self-storage. Just a few things while I go ahead and before we move on. Quest Trust Company does not provide tax, legal, or investment advice. All the information that you're going to see today is going to be strictly used for educational purposes. We've got a few things that we want to go over just before we begin the presentation. Right now, we've got an excellent promotion going on for those of you looking to invest in alternative investments in your retirement accounts. Our current promotion gives you 50% off of the application fee using the code NEW24. So just to get the new year kicked off, we wanted to extend this opportunity to those of you viewing with us today online. Okay. We also, if you guys are new to the self-directed IRA space and are wanting to invest in just assets that are unlike stocks, bonds, mutual funds, things that you typically see in your self-direct or in your 401k retirement account, give us a call at Quest. We'd be happy to speak with you about alternative investing and everything that you would need to know. Go ahead and scan this QR code today and speak with an IRA specialist such as myself or one of our senior specialists here at Quest Trust Company. Also exciting to introduce all of the viewers here today with a few events that we've got going on next month in February. We're trying to switch it up and do something a little bit different. And in February, we've got special webinars titled The Dynamic Duos. If you guys are in the office, Dallas, Houston space, or online, we're going to be featuring some power couples just to kind of speak on their many alternative investments and just how the dynamic of having your partner invest with you and push you along. And so tune in. We've got Austin February 1st, Dallas February 6th, and also Houston on February 8th. Okay. Um, and last but not least, we've got our Quest Expo. This is going to be taking place in June 27th through the 29th. It's going to be everything alternative investing. So if you're new to self-directed IRAs, looking for some investments to invest in, or just want to hear speakers like Anthony or possibly any other speakers presenting opportunities and educational advice on what they can do in their self-directed IRA and what they can look forward to when investing in these types of investments. Scan the QR code to learn more about these or this event coming up later on in the year in June. And just to jump straight to it, I'd like to welcome Anthony to the webinar today, and thank you for presenting with us today. He's going to speak on self-storage. Consumption is big in the United States, and I think he's got some great educational information to present to you guys. So without further ado, Anthony,
Hey, I
the floor is
appreciate
yours.
the introduction. Everybody, thank you for coming on this Saturday. Again, my name is Anthony Deluca. I'm down here in Orlando. I'm not quite sure where everybody's at, but my brother's out in Denver. My sister's out in Charlotte. So it's really cold. So Saturday, even though it's a Saturday, it might be a good time to listen in on this. So it's going to be a lot of good information. It's going to be about 35 or so slides. I'm going to go through it, but we're really going to focus on self-storage and why the industry has done so well in recession areas and what it looks like moving forward. So again, when you are investing, every single thing you do, it is small points and small pivots that can be such a big deal in your portfolio that can make the biggest change for yourself and your generational wealth for your family, right? So everybody's an expert when it's a bullish market, but it's the bearish markets that everybody turns to in question. So I'm going to touch base on why self-storage has done so well in the industry. So again, this is the agenda that we're going to look at today. So just quick intro. We're going to talk about investments very generally. I'm not going to go into any dissertation or anything. I've got 30, 35 minutes here. So just very briefly how they've done in recessions, in our latest recession, this COVID recession that we'll talk about. Then we'll talk about self-storage, the industry itself as a whole, holistically, how it's done apples to apples comparison. And then we'll look at our storage units brand and why we stand apart, the successes we've had, and the things that we offer on it. So again, just wanted to give a little bit more background on myself. I am the Vice President of Investor Relations for the Storage Units brand. I do have my CFP, and I do have a certified divorce financial analyst too. I've been in the stock market. I've been in the bond market. I'm here in the private placement, more real estate market now. I'm a partner, and I absolutely love it. I want to bring up the CFP piece because I'm not going to sit here and say that stocks and bonds are evil. I think people who try and pitch so salesy and they just don't give the true information, they're not objective, that can't be appreciated. I'm not here to say that stocks and bonds are evil. What I am here to say is that there are different avenues and ways that you can enhance your portfolio, especially in very volatile situations. And I think we can all agree that starting in 2020, late February 2020, basically through to today, we can have that argument that it has been a very volatile time. So that's why I'm really excited about the storage units industry and what I'm going to present today. Before I hop in, disclosures, we're talking about private placements, we're talking about an illiquid investment, and we're talking about real estate. Through the information, would certainly love to have you on board and talk more in depth. And if you're in the Central Florida area, would love to shake a hand and show you one of our facilities. But we do have to give these disclosures. And again, we're working with accredited investors too. So keep that there for only a brief second. We want to jump into more juicy stuff, but I'm going to throw this QR code up. I don't know if I have it on the back end. So if you have your phone, feel free to scan that. Would love an opportunity to touch base with you, either myself or Zach Wood. He was in the beginning too, the presentation. We'd love to have that dialogue with you. So I'll sit here for a moment, let that code scan, and then we'll get rolling here. So without further ado, let us flow into the first part, and that's investments in a recession. And I put this slide up jokingly, but is it really a joke? I mean, again, the past 3 years have been volatile at best. And I have a 401k, I have an IRA, and every time I go to bed at night, I really hope that there's not more news that comes out. Is another country being attacked? I mean, you have Ukraine, you have Russia, you have what's happening in Israel and Palestine. We had 2.5 years of a COVID economy, and really everything has just been such a pivotal moment that we really don't know what's going to happen. And it doesn't give you that peace of mind. Okay. Again, I'm not here to say stocks are evil, but if you can find a little pieces that can make a big difference, exponential difference, that's what we'll see. But again, let's just touch base briefly on what the investments and what it looks like in a recession. And again, recessions they come in a multitude of different factors. So a recession is when you have 2 quarters of negative GDP growth, that gross domestic product. So when you have 2 quarters, that is by definition of a recession. The definition gets tweaked depending on the political nature, and we won't go into that spectrum. But here's what the S&P looks like through recessions from 1950 to 2022. So all different shapes and sizes. There's good news and bad news to a recession. The bad news is that the average drop is about 21%. And you have to think about it like this way. If you're down 30%, for example, which is what the NASDAQ did during the 2022 recession, it's not 30% to get back up because your principal is depleted. It's a mathematical equation. You actually need to have about a 43% gain just to get back to even. Time value of money is very important, so that's something to consider. But again, objective news, a recession most recessions will last under a year. It's about 315 days. And there's actually a decent proportion too that'll statistically speaking, that you'll break back even at the end of the year. But again, you're still seeing these very volatile drops. And the recessions as of lately, which we're going to talk about, haven't been these quick recessions. But you look at some of them, the 2008, that was the financial crisis when banks were giving out loans to anybody with a pulse. You had the 1973 recession where you had the oil crisis out west. And what you also had is more developing countries where the industrial side was picking up. So the Eurozone in America was struggling. But we'll touch on a little bit of it. But what I'm really going to focus on is our last recession and essentially COVID. But these are what the recessions look like. That was the S&P I showed you on the last slide. But what you can see is that you have a supply shock recession, a balance sheet recession, a cyclical recession, and a growth recession. So your cyclical recession, that third column there, that's going to be usually your shortest. A prime example of that is going to be the dot-com bubble bust when you had way too much speculation on the internet coming to play. So that was about an 8th-month recession. Your balance sheet recessions can be very volatile. The 2008 is what I just brought up. Also, you had the 1920 Great Depression. That was huge speculation. But then let's talk about what we are seeing, what we just saw, what we just got out of, and what we're experiencing, which is that supply shock recession when COVID came about. So again, I'm not going to go into massive details of what happened, but again, March of 2020, we had this virus. Whether you agree with the decision of Trump did in 2020 or not, he closed the economy down to try and stop the virus movement. Well, that didn't stop the demand, and we're going to talk about American consumerism and how it's so pivotal for storage units and the success of it. But the demand remained absolutely high, but there was no supply. So what happened? Our inflation went up. Now, when inflation goes up, the Fed is going to, what they're going to do is they're going to raise the Fed fund rate to cool it down. But what we saw, and you're going to see in these charts coming up, is that you had a double whammy where you had inflation still rising, going to 8.6% in May of 2020. It actually hit 9.1% in 2020, which is the biggest inflation mark we had since the 80s. So we had that, and we had the Fed raising the interest rates because that's what they want to do to cool it down. So because of that, we had stocks being hurt really bad and bonds being hurt really bad. And I'm going to talk about that. But again, on the stock side first, what you see is that the price you see of a stock, the S&P, for example, it is the price of what it's worth, but it's actually a projection. Economists are projecting what the value of the company and the consumer demand and the expansion of the company is going to be 6 to 9 months in advance. So if the Fed is going to start raising rates, which we saw back in August, September of 2022 and raising it, they're going to start projecting, and that's why you're going to see the stocks completely decrease. Now, the one thing I want to note, tying back into storage units a little bit, is that for several years to that point of that fall of 2022, interest rates were nil. I mean, you didn't hear a conversation about a 5% CD. Treasury bonds were doing 0.5%. You could go get a corporate bond for 2-3% at best. During that time period where you were having no dividends and no interest rates, our investors in one of our private placements they're actually investing in our alternative investment fund for our storage units at the time. They were getting 8% dividend and a 4% waterfall on the back end. So when I talked in the beginning about making really small changes that can make a big difference in a portfolio, that's what I'm referring to. So how did that Fed fund rate change the spectrum of the stock market? Well, this is what we're looking at. How I noted past that the average recession is about 315 days. It's taken us 750 days to be able to get back to where we once were. And again, that goes back to consumer demand not being as strong, inflation being as high. Tech companies got absolutely hammered in 2022 because they couldn't expand. Tech companies rely on loans to expand their business because they need so much money for the development of the new technology. Well, if the loan's 8% or you have business loans that are up to 12%, how are you going to be able to expand? And that's why you saw companies like Microsoft, Google, Facebook laying off employees. So let's not have too much of a recency bias when we look at what we're seeing in the rally right now. This recession has had a big impact on the stock market. So you look at the stocks and you say, okay, we're struggling. Let's flip over to the bond side. Well, again, like I said, it was a double whammy. So what ended up happening is that when interest rates rise, it's an inverse effect on your principal, because if I can wait 2 months and I know that an interest rate is going to go from 3% to 5%, I'm not going to hold a long-term bond. I'm going to go keep doing short-term bonds and recycle. So those long-term bonds have to become more favorable. What are they going to do? They're going to sell at a discount. So if you own a bond, a 10-year bond, and you realize that you're down 20%, that's what you were seeing. And again, everybody who was in fixed mutual funds were more conservative or just as confused as the aggressive investor in 2022 and the recession that we had. So stocks weren't doing well, bonds weren't doing well. And then the last slide before we hop into the storage units industry is here's an alternative. People say, okay, well, when inflation's high, let's rally to gold. Gold is king. Gold is always going to be there. Well, gold hit a pinnacle when inflation was starting to rise, which would make sense, right? And there, that midsection of 2022, that June, July, summer area, look what it's done since then. So again, we still had that recession there in all of 2022. So even the alternatives, that inside the box mentality of what you usually invest in wasn't doing well. And I think that's why we are so excited about storage units, kind of a pun, inside the box, outside the box. But it's true. When you think inside the box investment, you think about the stocks, you think about the bonds, you think about just going in the mutual funds. But when you can peel back the layers a little bit and look at what else is out there, you can realize that there are some big advantages to it. So we'll hop into the storage units industry here. And the one thing I want to note off the top is that we're talking about boxes inside of boxes. This is not a sexy investment. And that is exactly why it has so much success. I was speaking 2 years ago about how this was is a kept secret that's starting to get out of the box and everyone's starting to see it. Now in 2024, there's no secret. Storage units is of great demand and it's not going anywhere. And we're excited about the numbers. And again, it's because it's not sexy, but it's efficient. So we're going to talk about that. But let's get to the hard truth. Let's apples to apples comparison. Why self-storage? And that's because of its strong returns. So look at its consistent performance against other REITs, against senior housing, against data centers, against industrials, against hot office leasing. Look at that performance there in the top 5. And I want to note very specifically that the 2008, the 2011, the 2015 marks, where it hits number 1, the S&P during those times had 0% returns or negative returns. And then you see storage units there in 2020 performing well, 2021 hitting that number 1 mark of returns, in 2022, that whole COVID sector. So let's peel the onion back a little bit more and think, why does it do well in such a bad environment? That's a really good thing to know and think about. And the reality is think about yourself. What was happening during the recession? You might not have been eating out as much. You might not have been going to as many theme parks, going on many vacations. Maybe, unfortunately, the private school for your kids is not happening this semester. Maybe you need to go to a public school. That new Cadillac, that new shiny Cadillac you wanted to buy, maybe that's not happening. But you know what the American consumer is not doing? They're not going and taking their stuff out of storage because they needed it in the first place, because there's such a consumer demand that's so strong that the self-storage facility becomes a second garage. And we know from owning self-storage facilities and the data that the top 3 items that are in a self-storage facility is antiques, it's important paperwork, it's basically backup furniture, and then it's toys. It's your motorcycles, it's your jet skis, things like that. So people aren't going to throw that stuff out. And that's why self-storage does so well. It's not the first thing that people turn to when they are in a recessionary environment. So what do those numbers look like? Pretty dang good, if you ask me. I love doing these apples to apples comparison. Far right, look at the S&P return. That's in consideration of inflation. Again, a solid return. Well, let's ask ourselves a real question. Where's the outlier? Looks pretty good there on the left with self-storage. Look at that exponential difference between what comes in second and third, with residential at 13.4, apartments at 13.3%. And if you're here in Orlando and all you people there in the Dallas, Texas area, you're seeing it too, this exponential boom. You're seeing apartments going everywhere. I will say apartments are a very saturated group, and this is an objective statement. So it's difficult to say which group you want to go with that can have the best performance and the best success. So, and we're going to talk about a little bit later how our performance has done, who we are and how we've had success. But again, the self-storage has done so well. And the second reason is because it's a lifetime investment. So what does that mean? Self-storage follows the life cycle of a human. And throughout America, somebody somewhere is doing one of the things that shows on this PowerPoint slide. They are upgrading their home. They're downsizing their home. They're getting married. They're having kids. Unfortunately, maybe they're getting a divorce. Their kids are going to school. Maybe it's military deployment. We saw during the COVID season, let's call it, there was so much transient movement between people with states because of COVID. How do you think self-storage did in that time frame? A time frame that was so uncertain in the IRAs and the 401ks and the stocks and the bond world. So again, self-storage isn't going anywhere as long as the American public continues to do what they naturally do, which is live a life. There's going to continue to be a need for it. The other piece, a third piece, which I touched on, is that the self-storage industry is so simple. It's not sexy, but it is efficient. So you look at the businesses that are opening in the first 5 years, about 50%, half or so, of business ventures will fail. You think of something like a restaurant you're opening up that has an unlimited amount of variables, if you really consider it, their fail rate is upwards of 80%, 80, 90%. The storage units industry fail rate in the first 5 years is 8%. Why? I'll show you our facilities later on, but they're class A self-storage facilities. It's simple. They're boxes inside boxes, clean AC, electricity. You have a worker, a manager, maybe one worker. We're getting to a point now where we have central locations, and these central locations will look at multitude of facilities, so you don't even need to have an employee working at the facility. And again, the consumer, the renters, are buying insurance on their products too. So it's as simple as it gets. There's limited variable. So because of that, and because of the demand that is showing, the profitability, the margins, I mean, the margins are amazing. You only need 29% occupancy, 29% occupancy to start seeing profits flow. That's 30%. I mean, you don't really hear that anywhere else. You definitely don't hear that in the senior living housing, for example. And then at 60%, that's net operation margins are stabilized. That means at 65% occupancy, barely half, you are actually net gaining and you are making money on a facility. Those margins are really important. And they're really important during a COVID environment too, where, again, everything got more expensive. Steel, for example, which is a big component of a self-storage facility, again, we had to deal with change orders when it came to steel. But I'll tell you later on about the ways that we were able to work around it. But again, it's these margins that we're able to keep because of how simple it is and the demand that we're able to maintain and actually survive and have success. So as an investor or somebody who's interested in self-storage, you want to ask yourself, where should I go as an investor? I enjoy showing this map, and I'm going to get an updated map, and I guarantee it'll be just the same. What this shows is that the darker states show population growth, population movements from 2009 to 2022. The larger squares show rent growth of a self-storage facility. So we want to look for the unicorns and where you want to go. Everybody in Texas, you see the population movement, you see that growth. Well, other states that are doing well are Florida, Georgia, South Carolina, North Carolina. For us and our brand, we're headquartered in Orlando. We're here in Central Florida in the Coeys where our headquarters is at. So pretty good spot to be in and pretty good niche, and that's where we belong. So as an investor, you want to go where the money's going, right? And so we follow that demographic, and we're seeing a lot of success in what we're doing. And these trend lines you have to continue to follow. Another trend line, so I'm going to get into a couple unique pieces about how self-storage has looked and what we're seeing and its continued growth. So this is a really interesting slide. I'm going to show everything, and then I'm going to speak of it first. So that top right, the bars, what it's actually showing is that from 2005 to 2020, the darker gray black bar, there's more self-storage facilities, but the bigger orange bars, there's less brick and mortar. So what I mean by this is that there's less brick and mortar institutions, which makes sense if you think about the growth of technology and the growth of e-commerce. But the usage of these businesses who are using self-storage has gone up nearly 80,000. So 1.5 less million brick and mortar businesses, but 80,000 more renters of self-storage. And that's in the bottom chart there, that business self-storage penetration, that shows it. And I always tell this story, and because it's a true story, it's a funny story, is that we're building our St. Cloud facility here in Central Florida. We had two gentlemen who were fishing in our land and our property on a nearby riverbed. So we went up, the superintendent went up and asked what they were doing. And they were with the municipality and they were hunting gators. Ironic because of Florida, right? They were hunting gators because they were getting notice of that. Long story short, the municipality of St. Cloud now rents one of our biggest self-storage facilities. So again, you're not just having you and I as consumers, you're also having businesses, you're having government municipalities that are also renting. So you're getting these different angles of demand. Now, I think we're seeing the self-storage trend. You're seeing it in where you might live, and then you're seeing it in the numbers and the data. Now, it's not like stocks where once it's known, it's too late. There's already been the rush. Okay, what's the next big rush? The self-storage industry is here to stay. And it goes back to this new age American that acts like they're minimalist, the millennials and the Gen Zs. They act like they're minimalists and they want to live in their urban environments and they want to be all cute and fancy. But the reality is they still love their stuff. So it's a mock, and it actually shows in the data. So what these two bar charts show is that the proportionality of a millennial and a Gen Z owning a home versus they're renting or who owns rent storage space is actually more proportionate. There's more renters between homeowners and renting versus the greatest generation and the boomers. So again, of course, the boomers and the Gen Xs are going to have more homes, but that proportionate to renting self-storage, Gen Zs and millennials lead the way at 28, 19%. they're not going anywhere. They are a booming population in their own right. So that's going to be a big driver. And another thing to mention too is those boomers, okay, maybe they're not the biggest owners of self-storage, but one thing to note between the boomers is that silver tsunami is coming, if you haven't heard about it, where the clip of 15,000 people per day are retiring. Well, where are they going to go? Let's go back to that map that we talked about, right? They're coming down to Florida. They're coming down to the Carolinas. They're coming to Texas. They're coming to Arizona, the Sunshine States. So again, as an investor, you want to follow the trend lines and you want to go to where it is. It's definitely and certainly in the Southeast, and we're definitely seeing it in Florida. So the industry is here to stay in multiple facets from multiple angles that we're starting to notice. And the projections show true. So these are the projections on the left show the actual year-over-year return in 2022. Nice to see self-storage right there at the top. Well, let's look at what 2023 to 2027 outlooks show. Self-storage is right there at 9.2% at second place. Modern logistics, cloud computing, in anticipation of that to be a success. But again, here's self-storage doing right well. And one thing to notice about the modern logistics is that's still a technology piece. And we know how technology did during a recession in 2022. The NASDAQ was down over 30%. So again, self-storage, not sexy, but certainly exciting. And then the last stat I wanted to show before we get into the third and final piece, which is who we are and how we work a little bit differently and kind of give some nuances on us, is a really interesting stat that I just thought was interesting to show. So annual revenue on the left side here, annual revenue is approximately $40 billion, which is nearly 53,000 self-storage facilities. So here's the fact that it surprised me, I'll be honest. That's more than every Starbucks, McDonald's, Dunkin' Donuts, Pizza, and Wendy's combined. So when we really put the meat and potatoes on the table, self-storage is of big need. And no, I do not believe it's oversaturated because of the population movement, because of the population growth that we're seeing, and because of demand that's coming from so many different areas. So we're really excited about the next 10, 15 years of the product. So let's touch on us and that product. So Your Storage Units is our brand name. People are surprised that we're able to get that, but we did. And we are built out of Orlando. So we build Class A self-storage facilities. I'll show a couple of them. But again, they're neat, they're clean. If you're going to a new environment and the new roads are being built and you see the good foliage that's showing up, you're going to see one of these brand new state-of-the-art glass facilities. You see it there on the screen now popping up. Very clean, very efficient. And that's what we look to do and bring that niche environment to a new area. So again, like I said, we're based out of Orlando, premium state-of-the-art facilities. We are closing on our 11th facility in Ocoee. It is going to be our headquarters. We're really excited about it. If you are in the Central Florida area, we'd love to give you a tour of it. We're actually going to have a grand opening in February, I believe. So the first 3 floors are self-storage facilities, and the top one is our headquarters. So excited about that. But that's our 11th facility that we've closed on. And we have 7 more that are being built right now and 10 plus 1 in the pipeline. So I'm going to list off a couple. Hope I can remember most in my head, but we have 2 in Kissimmee. We have Popka, Florida, St. Cloud, Florida, Ocoee, Panama City, Augusta, Georgia, North Augusta, Georgia, Aiken, South Carolina. We're building in Kannapolis, North Carolina, too, looking at areas like Nashville, Tennessee, too. And finally, we love the corridor of Florida, so Vero Beach, Cocoa Beach, Fort Myers. Our bread and butter is the Southeast. The statistics show that, the numbers show that, and that's where we're going to remain. So as an investor, I always say this: you want to be on Tom Brady's team and Bill Belichick's team when they were with the Patriots and they were winning Super Bowls every other year. And to be a part of this group is a blessing. It's just to talk about who we are. I mean, these gentlemen are fantastic in their own right, fantastic men, but also just in the industry, very successful. So I just want to touch on 2. Richie, it's very important, and it ties it together. Richie Webster, our CEO and owner. So Richie Webster came from New Zealand. Strong as an ox type man, came with a shovel in his hand as a pipe foreman 35 years ago. From the ground up, built a company called Rapid Building Solutions, which I'll tie in a moment. Builds 80 plus facilities for other public storage facilities and big hangars for planes throughout America. So he is the bread and butter and the thought process behind this in this big, strong construction group. So about 5 years ago, we all came to the table and he was saying, hey, I'm building these facilities for these other groups. Why don't I own our own brand. So that's how the Your Storage Units brand came to be 5 years. And in that time frame, as I said, we're closing on our 11th. We have 7 more that are shovel ready. We're moving on, and 10 plus more in the pipeline. And then Bill Johnston, I joke, but not really. He's more of a walking computer type of guy. His analytics and the data he runs are pinpoint accurate. Guy's MBA from Harvard, has a CPA. He's worked on over $1 billion of deals. I mean, what he produces is to a T. So our group is strong, and we're really excited about what we have to offer. And to tie that in with our partnerships, it's a really grateful and blessing. So how we're able to find success as an independent group and what we've been able to done is because of our partnerships with groups like Natixis, Rialto, and Adams Property Group. So to understand who we are and the layer of us, Rapid Construction Solutions is us. So we are our own construction group, building ownership of the land from the ground up. So we are that detail piece. Now, these other 2 pieces are, I would argue, the most important slides on who we are and why we're able to find our success. So we go into a joint venture with a group called Rialto. So they're a $10 billion venture group out of New York. And essentially, we go into a group venture, we find the facilities together, staying in that Southeast demographic, and we're able to build. And I'm going to show you the money breakdown in the next slide. Once we build these facilities going to this joint venture, we get a direct refinance from a group called Natixis. It's a French debt company. So in a rising interest rate environment, we were able to get refinances and a built-in buyer in Rialto off the bat, which really helped elevate and push our movement. And then again, Abs Property Group is a third-party management group, and we have oversight on them. So we're vertically integrated in the fact that we are in every single piece from development, the contracting, ownership, and to oversight and the management. So how that looks, and for people who are more interested in us and the private placement we offer, this is going to be a little bit more offline conversation, but not to get too far into the details, but to give some understanding. We build facilities in a joint venture on the left side here. Let's say it's $10 million to build the facilities. We bring equity to the table. Rialto brings equity, construction debt to the table too, non-recourse, which is very important. Once it's built to CO, certificate of occupancy, that's when we flip some of the money. We take some of the money out. Rialto takes some of the money out. And then Natixis comes in as a refinance, that bolt-on piece, and allows us to start filling the facilities. And that's really important. So the storage units equity side comes from our own money, net gains, and as far as also private placements too, which is what we offer and what we'll talk about in a moment. But that's how the strength of the partnership works and a little bit of the flow. Definitely take more of that offline. But a couple pieces, I got about 5 more slides, and then I'll handle any questions or thoughts that come through. But why our brand and any other brand that finds success, you have to stand out in anything you do in life, right? It's not just self-storage. You have to be unique and you have to be efficient. So for us, where we're able to stand out is that the industry of self-storage is fractionalized. 71% of the self-storage industry is mom and pop shops. And listen, I'm a man. I love mom and pop shops when it comes to getting food or buying groceries. In the construction world, it really becomes important to be able to bring a new, beautiful piece. So we can come in as that piece. And the rest are these big REITs, which take a long time. They're a big conglomerate to go into an area to put in a new self-storage facility. So we're able to come in as this niche group. We can move very efficient and put our boots in the ground and get our facility up and running. So 4 slides on demographic ideas, of what we do and how we're able to move in. Aiken, South Carolina was something that we wanted to hop on because we saw the household income when we did our demographic studies. Again, going back to the last slide where we're able to move quickly, boots on the ground, and understand the area. In our demographic study, we realized that Aiken, South Carolina had a red flag. There was too many self-storage facilities in an oversaturated area until we went in. And we realized that there were a bunch of mom and pop shops. What they could use was a self-storage facility like ours. Now, a self-storage facility takes about 15 to 18 months to get to that stabilization period at 65 to 70% stabilization fill rate. We were able to do it in 12 months because of the knowledge we had with this newer facility in a growing area in a higher income area. So that was really important. And when we put a facility, one thing that's really important to note is a path of progress. That's what this visual shows. It's a path of progress. You want to put your self-storage facility in a growing area that has a massive street line that you're showing with all your stores. And then the most of the left side there That's neighborhoods. That's people's lives. That's people having families and living the American dream. And that's exactly where you want your self-storage facility to go. The last piece before we get into the private placement and any questions is Kissimmee. That's the Disney area for people who aren't familiar with Central Florida. It's no surprise about the population growth that we saw. And again, we put 2 facilities in. They do over 50,000 net a month, and we have 2 facilities there. So really big growth and really big excited about that. But wanted to do one slide on this. More questions, would certainly love to take it offline. So we do offer a private placement. We offered 2 private placements in the past for our first 5 facilities. Those have closed. We're on to this 3rd one now. So this is going to be for facilities that we're building here on out. That's shown within the PPM. Like I said, take more questions offline. But it is for accredited investors. It's a 506C offering. So it is noted with the SEC. What we offer is, again, we did an alternative play, and I talked about that in the beginning when interest rates were so low. Now interest rates are higher. You can get dividends. We wanted to give more of a profit split, more of an equity play piece to your portfolio. So what we offer is a 6% annualized return. Those are, it's prorated. That's paid out monthly in the form of dividend checks. You can either do an individual cap or an IRA like Quest that I'll touch on. And then the profit splits on the back end. So what that looks like is once we get a facility, a group of facilities to a stabilization rate between about 5 years or so, a time horizon, we're going to take a tranche of those facilities together and we'll sell it off to any big private REIT. We get calls all the time, or any sovereignty, because they're always searching for real estate that produces dividends, interest, and equity. And again, I'll add briefly that you even see this with companies like BlackRock, who took houses off the market that actually just helped the self-storage facilities when interest rates were zero. So they're always not big private REITs and sovereignties are always knocking. So on that profit split at about a 5-year time horizon, there's 2 tranches. One's a 50-50 split where, and it kind of talks about this on the right side, the preferred member gets paid out first, and then the common member, which the preferred member being you and the common member being us, you get paid out first, we get paid out second. And that can bring you up to 15%. And there's a second tranche too that can bring you up to 25%. The PPM speaks of an annualized average term between 12 and 18%. And based on the numbers that we're calculating, what we're currently seeing, and the numbers that are out there in the ether, 12 to 18% annualized return after about a 5-year time horizon, very much doable. We're seeing that now. So I'll definitely field more questions of that offline. I know it can be a little bit trickier, confusing. We'd certainly love talking about that again. But the last thing I wanted to add is, I appreciate Quest Trust, the company bringing me on board. These private placements, you can invest. If you have an individual account, you can do a check and have that conversation. What's beautiful is that you can also go through a custodial IRA like Quest Trust Company, and you can actually invest and keep your investments tax deferred, which is a beautiful thing for a lot of our investors who are still working, who are in that higher tax bracket. So definitely would love to have that dialogue offline. You can talk with us or the group at Quest Trust Company. But other than that, I am done. I really appreciate the time. Like I said, I know it's a Saturday, so I'm really grateful that people were able to come on board. If you're up in the north or the west and it's cold, maybe it was a good listen. But I hope I gave good details. And other than that, I am done. Thank you so much.
Thank you, Anthony. Thank you for speaking on this and providing these great, it's great information on your opportunity and just the self-storage industry as a whole. Excuse
Yeah,
me.
absolutely.
Can you just speak to the individuals, about what the process is like? I'm an IRA specialist, and so a lot of times I get a call, and people really don't know what they want to put their money in. Can you just kind of talk to the process of someone inquiring to the completion of the investment with your group?
Yeah. And it's not a difficult process at all. So we have plenty of dialogue. We'll show any information. We'll send the PPMs, any disclosures that are needed. We'll work with the investor. We'll do a due diligence to make sure that they are accredited. And again, that's not that it's because it's a 506C, one has to be accredited. So to give light to that is somebody who has $1 million of net worth that's not their primary home, an individual who makes $200,000 and will continue for 2 years, or marrying filing jointly and doing that for $300,000 and foreseeable for two or so years. So we'll fill out all the paperwork if somebody wants to use an IRA, for example, it's not hard at all. You can do a TOA, a transfer of asset. We'll help fill out the paperwork, open in that Quest, and then the Quest is a custodial, and you can invest in a private placement through that, and you can TOA the monies over. And again, that movement is tax deferred. So the Quest Group and us will help with every step and process along the way. We do it with hundreds of investors, so it's not difficult. And again, it is a very, going back to what I talked about in the very beginning. It's not to say to dump all your money into one industry or one segment or one idea. You want to spread your money out, and that's the whole point. You want to arbitrage against volatilities, and you want something that's not correlated to the stock and the bond world. So yeah, it's not a difficult process, and we'll certainly help guide just filling out paperwork, getting it started, and the transfer as well.
Thank you, thank you. And now, is there a place that is investor storage, or how can they reach you or find more about the opportunities that you have to offer?
Yeah. So I can send out with this link. So we have an investor.storage website that I can give out, and my email and Wood's email is there too. Feel free to touch base with us. We're not predatory by any means. Hey, interested? Just send me some information. We'll send you our PPM. We'll send you some more disclosures on us, and we'll give you the website so you can look at it. You can look at our website as an investor too. So yourstorageunits.com is if you just wanted to be a renter. So you can see how we perform on that back end too.
Nice, nice. So for everybody looking to become a part of this investment, if you guys were looking to kind of see and things from the ground level, like you said, go out and check one of these spaces out, maybe see what the experience is like, so you can have both perspectives. The back end perspective and the user perspective. It always helps to kind of see things if you're in the Florida area or any of those areas where uh, ants self-storage units are. Thank you everybody for being present today on this webinar. And if you have any questions regarding self-directed IRAs, feel free to reach out to me at Quest. You can contact us via phone. It's 281-492-3434. My name's Freeman. I'll go ahead and post that in the chat. And likewise, reach out to Anthony for self-storage investments and anything else. Great to have you guys, and have a great weekend.
Thank you so much. I appreciate it.
Take care.